mentioned financial capital and non-financial capital. So just a few words on that before we ask the panelists to join. So financial capital, the money, non-financial capital, what is that? A gentleman by the name of J. Hughes, he formulated this notion of different types of family capital and articulated 5 of them. So the first one is human capital. Human capital is the people in the family, are the people in the family living the best lives they can live. The second one is intellectual capital, the knowledge, the collective knowledge within the family, and how do you educate family members, and how do they take that knowledge that they've got and bring that to the family in service of the family's purpose. Social capital, to me that's one of the most important ones. Social capital is the ability of a group of people to work together towards a common goal. And that's the thing that holds families together. You think about VSG and philanthropy, okay? So obviously there's a wealth division that sort of powers everything, and we'll get to that one later. But the social capital is we're all getting together and we've got a purpose, a mission, driven by the fact that we share some genetic material and we've got some shared values and we develop a shared purpose and we can work together towards that. Then there's spiritual capital, and that's our purpose. Why are we here? Again, VSG, every 8 years. Do we stay together? Don't we stay together? Does somebody want to leave? And if they're leaving, why are they leaving? And if they're there, are they there because they want to be there and because they're shared purpose? And the last one, and I deliberately call that the last one, is financial capital, the money. So if you've got the 5 of them, you can think of them like this. My thumb is financial capital, and the other 4, spiritual, intellectual, social, human capital, are my other 4 fingers. And J. Hughes says no. I'm going to put it like this. Because financial capital is not what it's about. It's about spiritual capital. It's about purpose. It's about family as a collective, a building block of society. The financial capital pays for it, you know, and yes, will it run out and will population outstrip it? That's a consideration, but that's something to be considered. That doesn't impact the purpose. When we think about family capital in those terms, that's really what it's about. It's about prioritising the human side of your family and the value in the family being the power that a family, a group of people, is far more than just individual people put together. The value of that collective. So when we think about non-financial capital, there are 10 domains and 4 of them are financial capital and 5 of them are health and well-being, the rising generation, family dynamics, the community, ESG, philanthropy, how we interact with the world around us, and the family's imprint, the family's legacy. What's the legacy of VSG going to be? Is it going to be the gold mine? No. It's all the good that they've done for the world around them. I remember one matriarch, close family friend, she says to me, "Oh, my son does so well." And I said, "That's very nice, but you know, look at what you've done in the arts. Look at the joy you've brought to people. That's priceless." She didn't get it, but but you do. So that to me is what family's about, and using the financial capital to power the other forms of non-financial capital. That's where you get the magic. So I'd like to invite our panel to come up. You know who you are. You're all mic'd up. Tim, you're here.
Would you prefer an in?
I'll go in the middle.
You're okay there?
Waiting on you.
Leave space.
Okay.
All right.
Okay. So now I'll formally introduce all of you.
Asking your position.
Tim.
Right. Yep.
Tim sits on the Prime Board and he's MD of business, the business segment. So what's the business segment? The business segment is business advisory and accounting, M&A, corporate finance, valuations, consulting, ESOPs. Been there for 10 years. Previously Ernst & Young, M&A, more M&A. Oh no, there's some debt there as well. Right? Yeah, for the purposes of M&A, right? That's Tim. Alix with an I. And if you connect with Alix on LinkedIn, she's got the grooviest logo. It's very cool. Alix is from a family business. She brings expertise in succession, governance, intergenerational relationship management, experience in leading, overseeing, transitioning multi-million-dollar family enterprises, including her own family businesses. She understands complexities of family business transitions through generational succession or external sale. Her focus is on governance structures and communication strategies which support effective leadership transitions. She basically does what I do, but in Adelaide. That's good. Peter. Peter is the co-founder of Alpin Group, and Peter's going to talk about something very interesting. But his career began in 2012 after 15 years in engineering, investment banking, and management, and realised that the traditional corporate environment wasn't a fit for him, and he wanted to do his own thing. So he co-founded Alpin Group, and the goal is of acquiring, operating, and growing small business in Australia, which is the engine room of Australian economic growth. But when you say acquiring, Peter follows this model, which he will explain, called entrepreneurship through acquisition, or also called a search fund, which is a model that funds an entrepreneur to start a business and be an owner-operator of that business. Is that
It's close.
It's close. It's close enough. I can't say everything. Finally, Ben. Ben is the other Altor person, and he's CIO at Altor. And Altor Capital is owned by Prime. So Ben has 20 years in advising and investing in companies. Started as a project manager with a national engineering consulting firm. I'm sorry to hear that. Then he moved into investment banking, corporate advisory, and wouldn't you know, a bit of M&A.
That's it. Love a bit of M&A.
And so he's partner and CIO at Altor Capital, which was acquired, he founded it with Harley, who's here, and who asked a very good question earlier. That was acquired by Prime. Okay, now over to you guys. And so this is going to go for as long as it goes, and afterwards we'll have some time for some Q&A. Okay, you're all mic'd up. Good.
Thanks, David, and welcome everyone again tonight. And would you all just briefly join with me in thanking David for doing a great job emceeing this evening as well. Thanks, David. There are some transaction junkies up here, that's for sure, but hopefully we can contextualise that tonight in terms of how that helps convey some of this transition of wealth as well. And Pete, we might start with you, and if I can ask you to kindly kick us off. The discussion around succession and the release of wealth via sale of family businesses is not a new conversation, but I think what may interest the audience here tonight is how the macro drivers and metrics, particularly demographics, have evolved so acutely to the current market settings. Can you perhaps give us some sense of what you're seeing out there in the market, particularly that supply-demand associated with business owners looking at succession and capital?
Sure. So I'll try and keep it quick. We had Bernard Salt speak to us last year at an event, and he went into a lot of depth. So if anyone wants the full pack, I'm happy to share it. But in simple terms, if you look at small business, as was mentioned before, it's kind of the engine room of the Australian economy. We've got millions of registered businesses, of which there is a large chunk that sits bigger than micro business, but smaller than the kind of business that a private equity or a trade buy might look to acquire. So talking about earnings of between 1 and 4 or 5 million. So number of employees between sort of 15 to 20 and about 100 to 120 employees. So picture a business of that kind of size and type. We don't have great data in Australia as they do in other markets, but the best estimates is that there's somewhere around about 150,000 of those businesses in Australia as we sit here today. If you then just run some relatively simple metrics over that in relation to ownership demographics and other things, and I won't quote specific statistics, but a majority of those are owned by people of retirement age or older, and a majority of those businesses don't have succession plans in place. And again, a majority of those are looking to exit in the next 5 to 10 years. So regardless of what number you run over that 150,000 businesses of that size and type, there's tens of thousands of businesses that in the next 5 to 10 years are going to look for some kind of exit. Unfortunately, based on every other metric that we can see, a lot of those will just shut their doors because we can't actually manage to facilitate that many transactions in such a short period of time. But there's a large supply factor coming in there. And the problem that I'll just kind of mention before I kind of hand back is that size of business is a really peculiar size of business if you look at it from a scale perspective, but also just operationally and functionally how it operates. So the number of employees is relatively small for the size of the operation. It probably doesn't have a very well-developed org structure. It's probably still highly reliant on the owner-operator. And so what that means is that even the smallest end of private equity and even a trade buyer is probably reluctant to come down and buy that size of business because it's in that purgatory between being too small to want and big enough to actually acquire. The missing piece in there, which we can get to later, is bringing the new operator in, and that's the part that I really focus on. So that's why, as Tim was saying, part of what I focus on is backing young entrepreneurs into that succession play along with the capital, and that's how we try and solve that problem in this particular slice of the market.
Yeah, I think, Pete, the other dynamic we're seeing is, unfortunately or fortunately, less and less of that succession being the children of those entrepreneurs as well, which requires the sort of that to be filled by entrepreneurs and professional business owners. Yeah.
Can I add two more quick things?
Please.
Sorry, I know I'm going off script here.
No, please.
But there were just two things that, like when we were listening earlier, and also, frankly, when my Uber driver dropped me off at the beginning, I got out of the car and I was walking through the car park and I looked across and there were some people standing there having just parked their car, trying to enter their number plate into the parking machine. I don't know if it was you, you might know. As I was walking in, I tried to avert my eyes because I wondered whether they were considering who might be the owner of that parking machine, because it's me. So I don't actually own the parking machine anymore, but it's one of my businesses that actually makes that brand of parking machine. It's an older model, so if you're struggling, this is a real problem raising this in an event like this, right? Because particularly when they're out there. But no, the interesting part about that longer story is that Duncan Solutions, which is the company that makes that parking machine, which is an old one, I will point out, used to be owned by the Salteri family, which also owned Tenix, and also co-founded the Transfield Group as well before the split in the 90s. So back in 2013, 14, 15, they were going through a massive divestment where they were selling a whole bunch of their investments, including Tenix and other things, including the Duncan Group, which had operations in America and also operations here in Australia. So me and my mate bought the Australian operations for Duncan Solutions out of that. So that was part of that succession, and they didn't have a home for that business if we hadn't have bought it, because it was too small for any other person to buy it, and the other way that we could buy it was because we could come in and offer that operational support. So I just wanted to kind of bring it to life with the kind of business that might be in that kind of size. Duncan Solutions now turns over about $30 million, has about 100 employees, is currently subject to ACCC because we're trying to exit at the moment. The only other point I'll just quickly make again to bring it to life, the Victor Smorgon Group was talking about the Stawell gold mine. The only way that they measure the amount of gold that comes out of that mine site is because I've got guys there that install the measurement instruments. Again, a really, really small business. When we bought it, had 5 employees. Now we've got about 50 employees, but manage all of the measurement instruments on mine sites across Australia. So I just thought those two examples might help to kind of put some meat on the bone around the kind of businesses that we're talking about that sit kind of under the radar, but they're still a really important part of the economy.
Terrific, Pete.
I think there's been a really big focus on people thinking about wealth in Australia and it being tied up in property, but there's a big there's not really a realisation about how much wealth is tied up in small business.
Yep.
And that's the opportunity.
Yeah, well said. I think a lot of the transactional outcomes, the bright shiny bits, get celebrated in the AFR, and everyone sort of gets a pat on the back. But there's an enormous amount of planning and pre-preparation that goes into that succession journey, which David and David both took us through. If I hand to you, Alix, I'm aware through your experience in advising multiple family businesses that many owners struggle with balancing personal, family and financial objectives in succession planning. What can help business owners create an environment that fosters constructive discussions and alignment amongst the stakeholders? And we heard a little bit of how VSG approaches it earlier.
Yeah, and that's that's at the big scale where there's lots of resources and things like that. I deal with businesses that are in this SME space that we're talking about, where there may not be the next generation, or if there is, they may not be educated to the level. There is a level of nepotism. I know there was a question earlier on the floor about nepotism, where you have these people in the business and how does that transition? You're not aligned. And all of a sudden, somebody comes in and goes, I want out. The founder, he's had enough, but there's been no discussion. A very good succession plan takes, on average, 8 years to happen, right? So, and that's from inception talks to actually occurring, which means that if you're wanting to exit your business in 12 months, it's not going to be a very fun ride for you, be it to the next gen or through a sale to a trade buy or anything like that. So what we do is we really implement family charters. Right? So if there's one take home here is if you are making operational and business decisions in your business or your businesses that you're advising, and everybody's meeting and they're talking about financials and they're doing all of that and the business is going really well, but there's no discussion about how family communicate outside of that, how they're communicating about what the business means, where the wealth, where the ownership or management structure sits, then a good place is to have and implement a family charter. And a family charter is just a way that we see the business for the family, as opposed to what business strategy is. What's the family strategy? What are we doing about, Joey down the corner that is, making the parts that do this, and how are they all communicating, and are we on the same trajectory? Does somebody want to make the business $100 million and someone wants to sell? Where there's no communication, you're not going to be able to find any common ground around it. So I do a lot of work with families about implementing family charters and really documenting how they're going to communicate, what happens if there's a dispute and that sort of factor. And we do that earlier and communicate earlier and earlier now. There's one business, mum and dad, they're in their 50s, the kids have just finished high school and neither of the kids are showing any interest in the family business, and they're already starting the communication. So that everybody's on the same page and everybody's doing, seeing that longer term strategy. So,
Nothing from you, Ben?
No, that's
Remaining with you for a moment, Alix, in that process, how have you seen the role of advisors assist in that smooth transition? Yeah.
I can draw on an example of when it's not smooth.
Yep.
So I ran a large in the scale of, reporting to the ATO for our family business, and we were having some trouble. We didn't really know what we were doing. We brought some consultants in, and what they did very, very well was divide and conquer our family. So they were not there from a family perspective. They were there, had very little experience with dealing with family members that are not working well together. So the choice of advisors that you have around the table needs to be not just your accountant, not just your wealth advisor, not just your lawyer. There needs to be people there for the founder, for the next gen, and whatever's in between, depending on the level of generations, making sure that everybody's being heard around the table. So that's probably one of the big learnings and why I actually do family business advising is because bad consultants can really damage family businesses. And I don't mean the business. Businesses can tend to continue unless you really stuff it up. But the family, some of those things that happen in that family can never be recovered. So making sure that you have people around the table that have more skills than just reading a P&L and a balance sheet or providing legal advice is very, very important.
Yeah, that right balance of trust and, as David said, independence as well to lean on. Maybe if we turn to some of the sources of capital that are pointed at this transition, and Ben, there's a range of those sources of capital available to facilitate the business succession journey. Why don't you take us briefly through some of those sources, how they stratify and differentiate against strategies, but also touch on how you're seeing the segment evolve and participating in the same, including the ETA space that Peter and Alix will both touch on for us a bit later.
Yeah, so I think that, you know, it's really important firstly to kind of understand what the objectives are in terms of that exit. So are we looking for a full exit or a partial exit? Are we looking to bring in, you know, strategic capital? So there's a lot of different reasons why a seller or a family might look at a partial sell down or a full sell down. But there's strategic capital now. It's available for, you know, partial investments that's really differentiated and is not the kind of traditional change of control transaction that most people would be familiar with, where a business is acquired fully. So there's a lot of flexibility with how families and sellers can think about how they transition out of a business, and then what sort of capitals are available to them. They're all different. They've all got different strategies in terms of the natural buyers of that business. It might be a strategic buyer that is in a similar or the same sector. So that's one particular avenue of capital. Could be a private equity fund or a financial sponsor. They're generally dealing with the medium to large end, as Pete sort of talked about before. They started off in the small end, but 100%. Over the last 10 to 15 years, those private equity funds,
growing the size of their funds.
They're managing billions of dollars, and it's obviously leaving quite a large market for new participants to come into, which we'll obviously talk about. You know, family offices have been a new source of capital as well, and that it's probably less traditional, but certainly families, now that they've got a lot of operating experience with business, are seeing opportunities to invest directly into business as well. So they're obviously another source of capital. And then we've got the ETA, which we've kind of touched on very briefly. And that, for us, I guess, is where really the opportunity is, because you can take the aspects of venture capital, where you're backing individuals and backing them into a business or assisting them buy a business, and really combining that with a traditional private equity approach, which is backing the cash flows of the business. So we think there's a great opportunity to look at that as a way to deploy our capital. So we run a number of funds at Altor. We've now done inadvertently about 4 ETA transactions through one of our funds, and we're seeing it as a major opportunity where we can participate. Obviously, at the point when all that transition and that family planning's been done, we then step in and actually help the business detach away from the family or the seller. There's obviously systems and processes that we can implement. So there's a lot of work that we're doing once we take ownership of that business to help grow. Sometimes family might continue to stay in.
Yeah, there's usually quite a strong transition, isn't there, between the selling vendor and the incoming management candidate? Yeah. Pete, we might sort of let you pick up where Ben left off. And why don't you tell us a little bit more about the entrepreneurship through acquisition ecosystem, which humbly you've really pioneered here in the Australian market, together with people like Alix. So please, why don't you tell us a little bit more about the segment
Sure.
which has had a pretty rich heritage overseas as well.
Sure. So I'll try and do, like, acronyms are a real problem, right? So like the whole ETA thing always throws people out. So I'll try and like not use acronyms to describe it. But that part of the market I was describing right at the beginning, so businesses with earnings of 1 to 5 mil, they're below the radar for private equity. They're too big for kind of usually kind of relatively simple management buyouts and things. So they kind of get stuck in this purgatory. And if you've got a situation like most of these where the founder or the retiring owner doesn't have succession in place, they're looking for some sort of exit. And the way for them to maximize the value of that exit is where the incoming buyer also brings the operator with them. And that's the crux of it, right? So it's called entrepreneurship through acquisition because effectively, if you look at it through the entrepreneur's lens, they want to be a business owner and they've got two options. So they either start one or they buy one. And so if they start one, they're a startup founder. If they buy one, they're an acquisition entrepreneur or they're doing ETA. Like it's as simple, that's it, kind of full stop, right? So then after you've got all these kind of individuals out there wanting to become business owners by acquisition instead of startup, you then build behind it an ecosystem of investment, which is all about investing in those entrepreneurs. And that's the kind of VC-like aspect of it that we were mentioning earlier, which is where a lot of the decision-making that as investors we make is entrepreneur first and then acquisition second. So you're saying, is this someone I think I can back? Do I think they've got the kind of grit and capability to work through the hard times of a small business owner and that kind of thing? And then after deciding that, yeah, this person, like picking jockey before horse, you say, yeah, I reckon this person's going to be a good operator. Now let's rally behind them and see if we can find them a good business to buy. And so that's effectively the crux of it. In other countries, for example, in the US, you might hear the terminology around a search fund. So a search fund I would describe as just one model that provides a structure for investors to back the entrepreneur. There are lots of different ways to prosecute ETA or this acquisition entrepreneurship, or whatever you want to call it. One of those is to raise a search fund. It's just a source of capital or a well-defined model that the entrepreneur can use to raise capital from investors for that journey. That's the simplest way of describing it. Search funds have been around in the US since the 80s. They were founded in Harvard and Stanford. They've been propagated by the major business schools globally for the last 4 decades. Not a single business school in Australia or New Zealand even wants to think about running a course in it, even though every major business school globally has a defined segment of their executive MBA targeted at search funds and ETA. But we'll get there in the end.
Just on that, just a quick show of hands. Until tonight, had anyone heard of search funds in the room? A quick show of hands.
Oh, that's a bit.
Yeah.
That's pretty good.
Oh, that's pretty good.
That's pretty good. So in Australia, the first search fund was raised in 2019. The first search fund-backed acquisition was made in 2021. And since then, I think we've now got 15 active search funds operating, of which there are about 8 operating companies that have been acquired via that structure. So that's kind of where we're at in this marketplace. But if you put that in perspective of do all the numbers off the stats I was reading out before, I don't know, 40,000 small businesses with earnings of 1 to 4 million that need to change hands in the next 5 years. Like there's an untapped number of kind of opportunities there.
And it is a very viable exit strategy for a founder-led business or multi-generational businesses where they're wanting to exit. And it's mainly because the entrepreneur that's coming in is really focused on the business and the legacy that came before it, as opposed, and I can't speak to PE purchasing, like I've not done that, but they're actually there for the business and they want to learn and they want the seller to be involved in that process so that they can continue what was going on. As we're all here for family businesses, some of the competitive advantage is based around the fact that it is a family business. So that these entrepreneurs want to buy that component of it. They're not trying to get rid of it.
And we've got examples in Australia, and actually one of the ones in my portfolio at the moment is a cardboard recycling business in Wetherill Park called Grimer Recycling. Process 100,000 tonnes of baled cardboard every year. We bought it from the founder who founded it 30 years ago. His son still works in the business today, working for the new CEO, who's the entrepreneur that we backed in to buy that business. And so even if there's other generations that are in the business that doesn't, and they weren't the one that wanted to take it on, and there was all sorts of other dynamics that they went through beforehand, as Alix was saying, there are still examples of where those people stay on.
Yeah, and I run our family trust after we've exited our family businesses, and I personally invest in search funds and the entrepreneurs because I'm operational. I ran an operational business. I really enjoy it. And I mentioned to the guys earlier that a lot of people were like, do property, do shares, but I didn't do that. I ran businesses. So it really speaks to kind of me that I can help out running other operational businesses because that's an investment type that I can understand very easily.
Yep. And just before we leave that, I mean, maybe just a little bit to underscore what we, I think, here up on stage and a bit more broadly see as an asset class opportunity. I mean, if I reflect back to the 90s, and David, I was fortunate enough to spend some time at the round table with you and Victor in Laverton, but back then, Pacific Equity Partners, which is our largest local private equity fund, was investing one of their first funds, which was a $24 million fund. All right, so they're now $2 billion funds. And if you think about the way that private equity has grown over the last 20 years to leave that gap that Pete describes, capital needs to fill that gap. And one of the things I find particularly exciting about this space is it really has the potential to be that next phase of private equity, underpinned by the search and ETA segment. And maybe Pete and Ben and Alix, just to give people a sense of sort of the IRRs and where the returns fit. It's obviously part of that alternatives class, but just where it fits in that return profile. Yeah, please.
So obviously because the data in Australia, obviously people have been buying small businesses forever, right? Yeah. That is not a new thing. But the concept of having a defined structure that puts capital into a fund, an entity that then gets used to buy something and then exits and goes through that full journey, that's still new in Australia. So the data on return metrics here is still yet to be playing out over the next couple of years as those go through their journey. But if you look to other markets of which there's really deep data, we can kind of use those as proxies. So Stanford, every 2 years for the last 30 years, has run a study on search funds in the US, and ISE in Spain has done the same for the last kind of 10 years, every alternate 2 years for everything outside the US. And the average returns for equity returns is about 35-36% IRR, with an average hold of 5 to 6 years and an average multiple of money of about 5.5 times money on those funds. So the way the model is structured, and I won't go into the detail, but I'm happy to do it later, I won't do it now. But the way the model is structured is that the ultimate incentive package that the entrepreneur gets if they hit all their targets has a threshold of 35% IRR for the investors. So investors that are going in, like that's their target number, they're trying to get to 35. And the average in that time has been about 35.
Yeah.
So it's a higher kind of return profile than private equity, lower, although I was laughing with some other people about maybe not so lower than VC at the moment. Lower than VC, lower risk than VC, higher risk than private equity. It kind of sits right in the middle there. And it's got a bit of both, like we were saying before, backing individual more than a business, but also having the cash flow of the business behind it.
Thanks, Pete.
I suppose the other thing too, just around structuring those ETA and search transactions, is there's shared upside. So the investors are contributing primarily all the capital. That they get their return first, and then the entrepreneur is aligned and motivated to basically stay the course.
Yep.
And get a successful outcome. So it's the way that they structure the transactions is very considered and takes into account the riskier nature that comes with search and ETA funding.
Yeah. So look, I think a space we could spend all night diving deeper on, and you should all please seek to catch up with the panel after this. But as we wrap up, I guess a quick comment from each of you around what sort of excites you over the next 12, 24, 36 months around the segment. And I think for me, kicking off, the other part of it is as you keep seeing those first echelon of buyers that have been backed into these businesses, build, grow and exit, they're going to bring through that next wave of entrepreneurs as well. So you get this sort of self-fulfilling or network effect of, or flywheel, effect of great people coming through the ecosystem, which will match that capital. But team, from your perspective?
I think I'm really excited about the opportunity it presents people or funds like ourselves with private capital. I think it's just an amazing investment opportunity, and we've spoken at length about that. But we're really keen to put this on the radar and have a real discussion about the opportunity, because it's not well known. So, there's a push, I guess, from Altor and Prime to talk about this opportunity and put it in the spotlight really, and bring it to light, because it's an amazing opportunity.
Yep.
I'll flip the lens on it, which is, I think it's a really big opportunity for the business owners. So historically, your exit figures possibly were zero if you were going to close down, and there's an opportunity where you can maximise your exit for those family members by doing something that's slightly not normal through a mix of vendor finance. And
Yep.
that. So I think that the opportunity is both sides. And you're going to see businesses sell for more just because there's, people wanting to buy them, where historically there may not have been anyone that wanted to buy them.
Yep.
So.
Yep. I guess there's lots of things I'm excited about in the next 5 years, so I'll try and pick a couple of things that might be relevant to the audience. So if I think about what I understand of this audience here, I think, we've mentioned the exit opportunity. For me, the thing that stands out and the reason why I moved to this direction in 2020 after having kind of owned and operated my own businesses for kind of 8 years before that, it's a really cool way to leverage your own experience in owning and operating businesses to then back the next generation of people and watch them then learn how to do the same thing. So if you've kind of made some of your own money by doing those hard yards, it's actually really satisfying to then deploy that money behind someone else. And I know it sounds mean, but watch them do the hard yards. It's amazing. So at the moment I sit on 7 boards, and so therefore I work with 7 CEOs, and all of them are all of them are first-time CEOs, and it's amazingly satisfying to watch them go through that learning process and become the CEOs that they want to become. I've got some that are in their first 12 months, and I've got others that have been doing it for 4 years, and even just watching the differences between them on that growth journey is really satisfying. So for me, the exciting part from an ecosystem perspective is that more that we can get ex-business owners or family office types involved in the investment side of the equation, the more we can bolster that mentor group for this next generation of CEOs, and I reckon that's super exciting.
Thanks, Pete. Ladies and gentlemen, we'll take some questions, but before we do, would you join with me in thanking the panel tonight? Thanks. Any questions from the room for the panel?
Hi, great speech, thank you. Lost my train of thought. What comes first, if you could clarify? Do you identify the entrepreneur first, or the target business first? And is it then a matching process to find the right entrepreneur for the right business?
Do you want me to go?
Well, it's all different. I mean, from our perspective, we've found the business, and there's been an opportunity to back an existing employee or management team that sits within that business to help the transition of the major shareholder. So our experiences have been a bit different to the traditional ETA, which is really about finding the founder, underwriting their search for the investment, and that search are then presenting that investment case to the shareholder group, and then going all in terms of funding that business. So there's always going to be slight nuances, but our experience has been a little bit different. It's kind of been more traditional management buyouts and management buy-ins.
Yeah, I would say that in terms of the approach that you take from a search fund or ETA perspective, entrepreneur first. But as an investor, you don't necessarily go out hunting for entrepreneurs to find. So I don't spend my time looking for entrepreneurs. It's a matter of what we're trying to do is build a marketplace where those entrepreneurs know that this is a pathway, and then they're out there initiating their own journey, and then they're looking for investors, right? So if I think about a day in the life from my perspective as an investor in this space, it's me getting approached by entrepreneurs who are saying, I'm ready to head on this journey, I want to raise capital, would you back me, right? And then it's a process of saying, well, I don't know, tell me a bit about your background and that kind of thing. A bit like you would do if a startup founder came to you and said, I've got this great idea for a new whatever. You'd spend as much time checking the founder as you would the idea, because ultimately the success of that is going to be founder first. Entrepreneur first.
Entrepreneur first, qualifying the entrepreneur, and also if you can add value to them.
Yeah. But you mean that atypical model is, correct me if I'm wrong, a searcher will approach, and for $500,000 that funds a couple of years of searching, due diligence, getting to know the founders. So that sort of funds that process of finding the asset, and then you get a first right to reinvest into the process.
Well, Timmy, what's the gearing ratio, or how much hurt money do you expect the entrepreneurs to put in?
Zero. Traditional.
Vanilla. So I always use this concept of vanilla. There is this vanilla traditional structure, which again, I don't want to end up diving into the detail of it because it'll take over. So I can do it another time if anyone's really interested. But there's this vanilla structure that's very well known globally. If I was to walk into a university in the middle of France studying search funds, I could describe the structure and it's exactly the same, right? So there's this vanilla global structure. Under that structure, the entrepreneur brings nothing. 100% of their equity they get on exit is earned in. What you do look for, though, is you look for opportunity cost. So the salary they draw during the search phase is like baked beans type salary. So they should just be putting food on the table, and that's about it, compared to the opportunity cost of their CV going to McKinsey or GE or that big investment bank, which is what they could otherwise do. So there's like an opportunity cost that they're investing. And then even when they become the CEO of the operating entity, they still only get paid the CEO salary of a 10 million revenue business, which is a lot less than what they'd get at an investment bank or something else. So it's really aligning their opportunity cost to the exit. And that then also gives you get a bit of buy-in.
Maybe our last question.
What point do you erase the capital? Because obviously if it's taking time to find the entrepreneur, the business, is it an open-ended fund, a closed-ended fund? How many investments in the fund?
Good question.
How much is the cash drag?
Usually after you've raised the initial fund, which might be 500,000 or 600,000 round, that's what it's tracking at the moment, 2 years.
Yeah. But the important thing, which is a big misconception because they use the word search fund, is it would be better described as a search SPV.
Yeah.
So if I'm an entrepreneur and you guys are all my potential investors and I want to become a business owner, I launch a search fund. It's a single, in Australia, proprietary limited entity that's got a single purpose to buy a single business. I raise my $500,000 into that entity. I draw a salary and due diligence out of it while I search. And then when I find my target, I come back to you all and say, now I need 5 million of equity. Let's put it all into this and go and buy that. And then I run that. So it's not a multi-acquisition fund. It's a SPV, really.
Yeah. So there are not yet any ETA funds in the way there are VC funds.
No, you will. There is that too. That's another whole conversation. They're a fund of funds. Yes, that's
A fund of ETAs.
Correct.
Right. Okay. It's time to wrap things up. So first of all, again, please let's thank the panel. just to sort of extract some themes, everything's connected. You know, I met with Mark, who was my customer 35 years ago, and I'm standing next to Pete, who owns Duncan, and I own Billing Bureau, and he's smiling because we work together on opportunities, and he does the meters and we do the infringement lifecycle management, which is pretty funny.
So he's the one booking the tickets, not me.
We don't. No. Neither of us do enforcement. Okay? They're the bad guys. But if we think about the themes of tonight, you know, continuity is the big one, and we think about family continuity. You know, what are your children, your grandchildren, the generations you'll never meet? What are they going to leave, and what are you going to leave them? In terms of non-financial capital, we talk about business continuity, succession, transition. We talk about investment continuity, and I love the theme of entrepreneurs investing in other entrepreneurs. You know, my family wealth is from property. I don't invest in property. I don't know property. I'm an entrepreneur. I invest in entrepreneurs. I invest in venture. Although now I'm going to invest in ETAs. And the other thing is, you know, owner-led businesses, founder-led businesses working with others for others, and that's prime. You know, an owner-led business who's not core customer, but so many of you around here are also owner-led businesses, and there's an affinity there, and a repeating cycle. Entrepreneurs investing in entrepreneurs, owner-led businesses working with other owner-led businesses, and it forms a sort of beautiful circle. And when we sort of round that up and think about legacy, you know, that's what I say is the important stuff. The money powers it, but the mark that you leave on the world. And these are hard questions. You know, what is your purpose as a family? What mark do you want to leave? And these are hard discussions to have because they get you thinking about mortality. And an important statistic, 100% of people die. We're all going to die. We don't want to talk about it, but it's going to happen. And having those discussions with our family, with our partners, and communicating, as we've seen, you know, families who do it well do, that's the key. The foundation of continuity is trust and communication, and they go hand in hand. So I just want to leave you that to think about, to think about, to talk about with your family, and invite you over to the other part of the room for some roaming desserts and networking. So thank you very much for joining us this evening. Thank you very much to Prime for inviting me to BMC, and I wish you all the best. Good night.